Hi, good evening, students. Can you all hear me? You can drop a yes in the text box if you all can hear me. And can you all see the screen as well? Okay, great. So let me quickly introduce myself. So I'm Nafrin Rizli, and I have completed my BA in Business Administration. So I'll be delivering the session today. So today's lesson is based on the Unit 9, which is about the bank account and bank reconciliation statement. So shall we get started with the lesson for today? All right, students. So let's get started with the part for today. So I'm going to quickly take you all through the content. So we'll be learning about the introduction to bank account, the double entries, bank statement, the reason for the differences in the bank account and the bank statement, bank reconciliation statement, adjusted bank account and bank reconciliation statement, like how to record things out. And then we'll be looking into the formats and some questions at the end. All right. So first, we're going to get started with bank account. Hope you all know what bank account is, right? One moment. Here we go. All right, so bank account. So bank account ideally is created by the business, and we do have bank account. We also maintain something called, the savings account, right? So the business, they maintain current account to make things easier for them to work with. For example, let's say like when they are doing a business and we deal with large amount of money, right? So maybe 500,000, maybe 600,000. So every time when we do transaction, we cannot take that money. Okay, it's not, secured, you would say. So what they do is the business, they create up something called the current account. Hope you all know what current account, right? So when you deal with, to deal with checks, you need current account. So what they do is like they create something called the current account to deal with checks. So it's easy for them to carry the 600,000 with a single paper, which is the check. So that is also a part of the bank account. So to make the cash transaction easy to get through conveniently and securely, they use the current account there. So the businesses are given with checkbooks when they have open current account, so they can do a single transaction without using the cash but using the check there. So bank account and the cash book, both of these are treated as assets account. You know what assets are, right? So assets account. So we have 5 elements in accounting. We got the assets, liabilities, equity, income, and expense. So this bank account and the cash book are treated as assets account. Okay, so whatever the effects that you get for the assets account, you get to the bank account and the cash book as well. So every time we do a transaction, we have the double entry. So when you carry out transactions with bank account, we deal with the principal just like how it works with the assets. So we have the one transaction which is debit and the other transaction which is credit, so that you can maintain the accurate cash flow and you also can maintain a proper balance. So with the basic understanding of what this bank account is, we're going to move on to the double entries. So double entries are very important because you might get questions where you have to write the double entry for certain transaction. And if you do know the double entry, it's easy for you to record things out as well. So first double entry is deposit of cash in the bank. So let me quickly explain you this table to get an idea. You might know this already if you have studied, accounts in grade 10, right? So this is something very familiar to you, right? So what happens when the elements of accounting increases and decreases? So these are the 5 elements of accounting. We have got the assets, expenses, liabilities, income, and equity. The 5 elements of accounting. And what happens when it increases and when it when it decreases? All right. So assets, when it increases, you would record it as a debit there, and if it decreases, you would record it as a credit. Same effect on the expenses as well. So assets and expenses, when it increases, you would write it as a debit entry, and if it decreases, you would write it as a credit entry. But when it comes to the liabilities, income and equity, all of these are treated the other way around. So when these 3 elements increases, we would write it as a credit, and if it decreases, you would write it as a debit. Are we all good with this table? If it's a yes, you can type yes in the chat box. Okay, so wonderful. So now I have got a question, that is deposit of cash in the bank. When you deposit cash in the bank, what are the 2 accounts that you would find? Exactly, wonderful job. Okay, so those are the 2 accounts that you would find, the bank and the cash. So when you deposit cash in the bank, what happens to the cash in the business? Will it decrease or will it increase? Exactly, it decreases. Okay, the cash in the business decreases because now let's say, like as a business, you have around 10,000 with you in your hand, and when you deposit it to the bank, you don't have money anymore in your hand, right? You will not have that 10,000 because you have deposited into the bank. So it decreases. And cash belong to which category out of these 5? Cash belongs to which element? Exactly, there we go. It belongs to the assets category. So we know when assets decreases, it is recorded as a credit. And the other account that is involved is going to be the bank, the money that you have kept in the bank will start increasing. And we already know that bank and cash are treated as assets. So therefore, whatever the effect that you find in the assets will take place for these two ones as well. All right. So therefore, the money in the bank will increase. We know when assets increase, that is a debit. Therefore, it is treated as a debit. So bank account debit, and the other account is going to be the cash account decreases because you are giving the money out from your business. So therefore, it is treated as a credit. So I hope you have already received something like this, right? The worksheet. Can you all quickly write the double entry for deposit of cash in the bank? Okay, quickly write it down. Deposit of cash in the bank. What are the two accounts involved? Bank and cash. So write the debit and the credit entry. The current account is like it is a bank account that is created by the business to work with the cash easily. So where they start dealing with the checks. So since it is a bank account, it is treated as an asset. Exactly. So bank account debit and cash account credit. There we go. Okay, so bank account credit, you can start typing. If you want me to type, I can do that. So bank account debit, cash account credit. All right, so now let's move on to the next part. Hope you all done writing. The next is going to be deposit of checks received by the. So checks from debtors and the cash sales are initially debited to the cash book. Now let's say that the debtors, so debtors are right, so who owe money to you, they are called the debtors. Okay, so like let's say some some business they purchase goods from you, right? So in that case, they might give you some money using the check. Okay, or maybe you do sales and they give you money using a check. So what they do is when the business get money as a check, they would first record it in their cash book and then will start depositing that money to the bank. So therefore, deposit of checks received by the business will also have the same double entry, just like deposit of cash directly to the business, which is bank account debit and cash account credit. Okay, the same double entry will have. So while we do each double entries, y'all can keep writing into the paper, all right, the worksheet that you got. So deposit of cash received by the business is where the business will pay you money like the other businesses. Let's say you are selling some stocks, so some other business purchase from you and they might give you check instead of cash. So what you do as a business is you would record it in your cash book and then amount you will be depositing into the bank. So this will also have the same double entry just like the first one. Okay, depositing of money into the bank account. Are we all good with these two parts? All right, great. So next, moving on to the other one. Now let's say that you have got the checks from another business, but in here you're not in cashing it. Okay, you're not converting into the cash. Instead, you're directly depositing it to the bank. Okay, you're directly depositing the check into the bank. So in this case, what we do is, so if you are depositing something directly into the bank, the check, you will fill something called the deposit slip and you will get a carbon copy of it where it will be used as a source document for you that you have received a check. All right. So in here, the double entry will be here, the cash is involved. The reason is because we are not encashing it. So the real purpose will be recorded. So for example, let's say the check received from sales. Okay, so you have done a sales and you received a check worth of 10,000 and you have deposited that check directly into the bank without encashing, okay, without converting that amount to cash. You have just directly deposited that check into the bank account. So do you all wish to give a try writing the double entry for this? You can type in the checkbox. All right, so there we go. So what can you all hear me? Hello? Okay, I hope you all can hear me, right? Hello? Hello? Hello, can you hear me? Okay, that's great. Wonderful. All right. So since you are depositing, now when you do sales, sales are increasing. So what happens when sales increases? Sales belongs to which category of accounting?
Income.
Yes, the income category. There we go. So when income increases, it is credit. Okay. So the money in your bank will also increase, which is part of assets. We know when assets increases, that is going to be debit. So this transaction, the double entry is going to be bank account increases. Therefore, it is debit. And sales, which is a part of income, increases. So therefore, it is credit. So the double entry for depositing checks immediately to the bank is going to be bank account debit. And you have to write the amount since they have given you the amount as 10,000. If it's a question with the amount, all right. So when you're writing double entry, you can just write it as it is. So it can be the relevant income account or something. Okay. So bank account increases debit. So bank account debit and sales account credit. Next is issuing check. So when you are issuing check, what is going to be the double entry? So when you issue a check, the double entry is going to be, okay, so this is about the dishonored check actually. So you know what dishonored check is, right? What is a dishonored check? Okay, issue is like you are giving the check to someone. As a business, you have written a check and you're giving to someone. That is what you call issuing. Okay, dishonoring check. Okay, dishonoring check is like when you don't have sufficient amount of funds into your account, or when you have placed an incorrect signature, or you have made some errors in writing, the bank will reject your check. This is what we call the dishonored check. where the bank start refusing your check to take it because they don't believe whether you have written it. Okay, so because you give a signature to the bank and the signature that you mention in the check is different from that, so they dishonor the check. They're not going to take it. Whether if you have deposited check or issued the check out, it turns dishonored because of these reasons. So the bank will send you something called the check return notice. So then you will understand, okay, my check has been dishonored. So this is what we call dishonored. So whatever you have recorded into your account will start reversing. Reversing is like you have to do the opposite of it. So when you deposit the check into the bank account, you have a double entry, right? So you have to reverse it out, which turns to be that you have not done that particular transaction. Okay, so to get a zero balance, you would do a reverse of transaction since the bank has dishonored the check. So you have already got a question over here in the worksheet about what is meant by dishonored checks. What are some reasons a check may be dishonored? Can you quickly write the answers for these two questions? Okay, start writing the answers for these questions. What is meant by dishonored checks? And what are some reasons for the checks being dishonored? So you could write it as dishonored checks are the checks which the bank refuses them due to some issues like insufficient funds, incorrect signature, or the errors in writing. And the ones that are highlighted are the reasons for the check being dishonored. Okay, let me know once you're done writing. Okay, great. So now let's move on to the next part, which is about dishonoring of deposited check. So, okay, which is like you have deposited a check into the business. Okay, I mean the bank account. You get a check and you have deposited into the bank account, and the bank says that this is a dishonored check. So what you do is whatever you wrote in the debit side, you would write that account as a credit side, and whatever you wrote in the credit side, you would write it as a debit entry. Okay, this is what you call reversing the transaction. You write the opposite of it to reverse the transaction. So it's just like it turns to be like you have not done that particular transaction. So dishonor check. So what is the double entry if you have deposited some money into your bank account? What is a double entry if you have deposited something into your bank account? If you have deposited money into your bank account, what is a double entry?
Bank account debit, cash account credit.
Exactly. Bank account debit and the cash account credit. So this is the double entry, right? So since this is a dishonor check, the accounts turn to be reversed. Okay? Reversed is the complete opposite of it. It's just like you have not done that particular transaction. So it might be that you have deposited cash, okay, where the cash turns to be a debit, or creditors, or it's like the debtors have paid you some money. Okay, first example we learned when a debtor issues you money. Okay, so or relevant account, maybe the sales account. Okay, so it's just like you have not done the sales. So it turns to be the complete opposite of it. So it might be a cash account, or it might be a debtor has directly deposited a check into your bank account. So you're depositing the check that was issued by a debtor. You know who debtors are, right? Who are liable to you, the people who has to pay you money. So it turns the reverse. So whatever the entries that you have written in the credit side will turn to be a debit. So debtor's relevant account turns to be a debit, since the check has dishonored, and the bank account which was debit turns to be a credit. So it is as if you have not done that particular transaction. Are we all good with what dishonoring of this deposited check is about? Is my voice too low? Can you all hear me clearly? Is it all good now? Okay, great. Okay, so hope you understood what dishonoring of deposited checks are about, right? So where you start reversing your transaction. Are we all good with this part? So for example, let's say, yes, the relevant, okay, relevant issuing check. Yeah, I'll come back to issuing a check in a while. Okay, so now let's quickly complete the deposited check and then let's come back to the issuing of check. I didn't still explain that part. All right. So dishonoring of deposited check. So you have got an example here. It says a check received from a debtor for rupees 12,000 and deposited in the bank account had been dishonored by the bank. So let me quickly underline the keywords. That is, you have received a check from the debtors. Debtors are the people who are liable to pay you. So the bank had dishonored the check, maybe because the signature is incorrect, or maybe the name written is not correct. Okay, so that might be the reason. So I'm going to ask you a question. When the check that you have received by a debtor, when you deposit directly into the bank account, what do you think the double entry is? What is a double entry for that? If you are depositing the check directly to the bank account, exactly. Yes. So you have the bank account will start increasing. So we know when bank increases, that turns to be debit. And next one is going to be the debtors. So debtors are also assets. Since debtors are paying you money, the debtors count will reduce. Okay, the debtors count will start reducing. So when debtors decreases, it is treated as a credit. So this would be the double entry when the debtor's check is directly deposited into the bank. So since this check is dishonored, what happens next is you have to write the transaction the opposite way. That is, the debtor's account, when you get the cash, I mean the check from the debtors, you wrote it as credit, right? So since this check is dishonored, we have to write the opposite of it, where the debtor's account turns to be credit of 12,000 and the bank account which was debited at the beginning will be written as a credit, the opposite transaction, which is called reversing. So now it's just like the transaction had not taken place. Are we all good with this part? Okay, so y'all can quickly write down the double entries, okay? Then and there when we start working on it. Okay, next moving on to dishonoring of issued check. So I told you at the beginning, you as a business will deal with certain transaction, right? Let's say if the transaction is worth 500,000, 600,000, every time you can't carry cash with you. So at that time, what you do is you will start using a check. So you will issue a check. You call it as issuing check. So from your business, you will write the amount and you will give it to the respective person. It can be a creditor or it can be your supplier. You can give the check to them. Okay, when you do a purchase or when you are liable to pay someone, okay, those people are called the creditors. So then you start issuing a check. So let's say that you are issuing a check to a creditor. Okay, when you issue a check to a creditor, what is the double entry? When you are issuing a check to a creditor, so always remember issuing cash and issuing a check involves. When you are issuing a cash account involves. Okay, so just you have to change the word as bank when you issue a check. Okay, so creditors account, debit, bank account, credit, exactly, there we go. Okay, so when you are issuing a check to your creditor, creditors will decrease. Okay, the amount of creditors that you have will decrease because you are paying the money, right? So creditors belongs to which category? The elements of accounting. Which category? Exactly, the liabilities. Remember the table. When the liabilities increases, it is credit. When the liability decreases, it is going to be debit. So therefore, the creditors are debit. Creditors account debit, and since you are paying using the check, bank account involves, so bank account credit. Okay, so this will be the double entry when you issue a check. But the issued check is dishonored. Come on, what do you think the double entry is when the issued check is dishonored? Exactly the opposite of it, how it works. Can you all quickly type the double entry? For dishonoring of issued checks. Exactly, there we go. We have to write the opposite of it, where the bank account comes as bank account debit and the creditor's account will turn to be a credit there. Okay, so it's a complete opposite of it. It's just like you have not done the transaction. Are you all good with what this dishonoring of issued check is about? Any questions, anyone? All right, wonderful. So we would reverse the transaction when you dishonored. Okay, so his account or the relevant account will start decreasing. So that's going to be the credit. Okay, so hope you are done writing the transaction, right? The double entries in. So are we all good with these transactions? About honoring of. So let's quickly question achieved by the best to a creditor of 50,000 was dishonored when presented to the bank. So as a step, you're going to underline the keywords. Okay, so underlining keywords makes things easier for us to understand the question better. So the issued by the business, so business is issuing a check to creditors and it's 15,000 is honored when you have pressed the bank. When you issue a check to the creditor, what is the transaction? I'm double entry. Write the double entry when you issue a exactly the creditors a credit worth of 15,000. Okay, so this will be the trip when you issue to the creditor. What happens when the check is this? Exactly, so we write the opposite of it. Write it. How do you the entry is? When the issue checks on it. Exactly, there we go. So we have first the transaction happens there is the bank account to be a debit and the credit account will turn to be a credit, 15,000. So we have to write the reverse of it in here. Here's account turns to be a credit, account will turn to be a debit. So this is about dishonoring of issued checks. Have you good with the double entry so far? Any questions on the double entries? Okay, great. So next is going to be bank. Anyone have got an idea of what this overdraft is about? What is bank overdraft? You all hear me clearly? Um, kind of short-term loan. The bank overdraft, exactly that we have there. Okay, so bank overdraft is like, let's say that you have a current account and let's say you have around 10,000 in your current account, but then you are writing for you're issuing a check for 20,000 for someone. Actually have around 15 in your bank account. So when you give the check to the okay, so if you know when knows that you are very loyal to the bank and you do things on time, so what the bank does is that they would extra 5,000 on behalf of you. Okay, so you actually have only 15,000, but you have written a check for 20,000. So the bank will give you 5,000. They will pay on behalf of you a 5,000 and you have to return it back. It's a liability to the business because we have to return it back. We owe the bank in that case. Okay, so it's just like we are being a debtor to the bank. All right, so that is what you called bank overdraft. So it says banks may allow customers to issue checks exceeding their the bank balance. So for as example, just like I told you, you have 15,000 in your bank account, but you are issuing a check for 20,000. So where the bank pays 5,000 on behalf of you. So this 5,000 is something that exceeds your balance. Okay, the balance. So it is paid on behalf of you by the bank. So this 5,000 is considered as a bank overdraft. It's treated as a liability to the business. It's just like we are being a debtor to the bank. So this 5,000 we have to pay back to the bank. Okay, so that's about the bank overdraft. So you know what bank account is. So we have discussed about this so far. What happens when the bank account increases and what happens when the bank account decreases. So favorable balance is a positive one, which means that you have more cash into your bank account. If it's unfavorable, then that is treated as a overdraft. You would say uh it's like less money into your bank account. You owe the bank kind of thing. Okay, so favorable means it comes to the debit side, just like how you treat the assets. When asset increases its debit, so you would write it in the debit side if it's a favorable bank balance. When they use the word favorable bank balance, then you would start the balance from your debit side. Next is bank statement. What is a bank statement? What is a bank statement? Okay, so bank statement is something that is sent by the bank. Okay, so you will maintain a bank account on your side as the business. The bank will maintain your statement on your behalf. They will maintain all the transaction and you will separately maintain a bank account. And what happens is once the bank sends out the bank statement, you can start comparing with your balance and their balance. So here the issue comes. Okay, so that we will be solving it sometimes. All right, so just remember that bank statement is the statement that by the bank which tells you the details about the balance of the bank account, the whatever that is the debit side, whatever that is the credit side, how much the bank has from you, if someone has directly some money into your bank account. So all of these things you can identify using a statement. Yes, you are supposed to write what is bank statement into the all right. Exactly. So good job. At the end of the month, the bank would make a transaction, whatever we did that particular month, give us a bank statement. It's like a printed document. All right. So back to the student. So there are some questions that you need to answer. What is bank overdraft? What is bank? Right. You are writing these as then and there. So let me know once you're done writing what bank statement is about. Okay, so hope you are done writing it. So about the bank statement, where the bank statement is that, as I said, the business will maintain something called a bank account, and the bank will maintain the bank statement. So the difference might arise both the sides. So we might have recorded transactions which is not a statement, while the bank might have written the transaction which is not in our so at the end we will comparing both of them. Will come to a point there. Yes, it is a statement she's issued by the bank. So bank statement is a statement that issued by the bank, includes the transaction that had taken place for the month. That is what you call the bank statement. So bank overdraft is the amount where the bank start paying exceeded amount on behalf of us. So bank overdraft is like when you issue a check the that is in your bank account, the bank will pay the extra amount on behalf, and this is called bank overdraft. It is like a statement. It's just like an account you would. It has a debit credit balance in every transaction that you have. So you call it as a not a real statement, but it's just like the accounts. So the bank overdraft is about you to a check exceeds your bank account balance. For example, if you check for 50,000 but your account balance is 50,000, what happens is the bank pays extra 5,000 on your behalf, and this 5,000 is treated as a bank overdraft. And this is treated as liability to the business as it has to pay this back. All right. So that amount is called the bank overdraft. Guys, is my all right. So move to the next part. It is about the reasons for the difference between the final balance and question like this in the tute as well. So focus on this. This is a area in today's session. You can understand this better. It's really for you to work out the question related to the account, the adjusted bank and the bank reconciliation statement. So the reasons for the difference between the final balance of the account and the final balance statement. These are the reasons why you have two different balances. One is the okay season is going to be the check if but not presented to for payment. So it's called unpresented checks. Unpresented checks are the checks which is issued by the business but not yet presented to the bank for the payment. So these checks are called the presented check. So we have recorded this as a check that has issued. Okay, we would have reduced the bank account. We would as a bank account credit transaction. But the bank has not even recorded this section because it is unpresented. We have written it in our account. Bank has not written it. We have recorded it as a payment. The money has gone up. For example, let's say like example, um, issuing a creditor. So what is the W? You have issued a check to the creditor. Okay, so what's double entry? Okay, give me a moment. I'll check with that part. I'll try changing my connection. Let me know how it works now. Can you all hear me? Or is it still lagging? Hello. Okay. Still. Okay. I hope it's okay now, right? Um, can others confirm, please? Okay, great. All right. So let me explain this part to you. The first one is the unpresented checks. You have issued checks and that is not presented to the bank, which is called the unpresented checks. Can you tell me the double entry if you have issued a check to the creditor? What is the double entry if you have issued a check to the creditor? Yes, creditors. Creditors account debit, bank account credit. Exactly. So you have recorded this as a credit in your bank account. You have recorded that this issuing of check as a credit into your bank account, but it is not presented to the bank, which means in your bank statement you have no transaction like this. So you have issued, you have given the check actually to the bank account, the bank, but they have not, it's not present to the bank account. For example, let's say there is a specific period the bank prepares its statement. For example, let's say the bank will start preparing the statement on 28th. Okay, for example, I'm just telling you 28th of every month. But you have now, let's say at 4 p.m., they are done with finishing the statement for the month. And you are maybe that you are sending a check on 28th or maybe 28th after 6 p.m. or something. You're just depositing a check, or maybe like the next day 29. So these checks are not presented by the bank. They don't make another statement or something. Okay, the same statement that they have prepared on 28th will be given to you. So this particular check that you have issued to the bank will be recorded in the next month's bank statement. Okay, so it's just like that. So it's unpresented to the bank. Unpresented to the bank. That is what you call this check issued but not presented to the bank, or maybe some other issues with your check. That is why it's not presented to the bank. Okay, so what happens is you have recorded in your book this particular transaction, but the bank has not even recorded. So therefore this particular transaction is not presented in your bank account. So in this case, what happened is there will be a decrease. Okay, the business bank account will be lower because bank account is credit, right? So 15,000, let's say 15,000 is what you have issued and you have written. So 15,000 in the bank account that you have prepared in the business will be written in the credit side, which means it lowers your balance. But there is no such transaction like this in your bank account. So there will be no decrease in your bank account's amount. So this causes a difference. So this is called unpresented check. The check that you have issued but not presented to the bank for payment. And the next reason is the check deposited but not realized. So you have now first case was you have issued a check, but here it's like you are depositing a check to your bank account, but it's not realized. Let's say a debtor has paid you money or you're getting some sales income and you are depositing that check immediately to your bank account, which increases your bank balance when you do that. Okay, so it's the transaction comes like, let's say if debtors are paying you money, what is the double entry? if you are receiving a check from a debtor, what is the double entry? Exactly, there we go. So bank account debit and the debtor's account credit. So this is going to increase your bank balance, isn't it? Because it is written at the debit side, which means it will increase your bank account's balance. But this particular transaction is not realized by the bank, not even recorded this. Okay, they have not even realized this particular. Okay, so this will lead to an increase in your bank account, a decrease in the compared to the bank statement, you would say, because there's no such increase in your bank statement because this particular thing is not being realized into your bank statement. All right, so that is about the unrealized thing. Direct remittance. Direct remittance is like maybe that you're not aware of what it is. Like, let's say you don't know whether someone has deposited something or not. So they have done it to you. Let's say every month now you have rented your factory or something. Okay, as a business you have another factory, so you have rent it out. So every month they directly deposit some amount to your bank account, but sometimes you might have forgot to record it. But the bank, since the direct remittance are deposited directly to the bank account, the bank will know, okay, there is something that is deposited every time. Maybe the interest, okay? So interest that is directly deposited into your bank account, or maybe the dividend. What is a dividend? What is called a dividend? Any idea, anyone? What dividend is? Okay, so dividend is like, let's say that you are purchasing shares from another company. Okay, so you're purchasing shares from another company. So when they prepare the income statement, the profit or loss statement, from the profit they will give you some amount per share that you have purchased from that company. So if they are preparing statements like maybe monthly or maybe like yearly, they might give you some amount of money, and this is called the dividend. So these are the income that you get when you invest your money into the shares. It might be around, for example, sometimes in some companies, 2 rupee per share, or 1 rupee per share, or 1 rupee and 50 cents per share. It depends on the company. All right. So this is what we call the dividend. So dividend income is directly deposited to your bank account, or the interest income is directly deposited to the bank account, or maybe the rent income is directly deposited to the bank account, and you're not aware of it. This is what we call the direct remittance. Okay, the funds that are directly deposited to your bank account. So since it is directly deposited to the bank account, the bank will realize it. Okay. So in your statement, the bank statement, this will appear, but in your bank account, you're not writing that down. So it shows up as you're having a lower balance compared to the bank. So that is the direct remittance. Next is the payment on standing order. So let's say now as a business, since you are working, okay, since you are a huge business, every time you can't check whether you have paid the rent on time, or whether you have paid the loan installment, or whether you have paid the insurance premium. You can't do that, right? You can't keep a track of it. So what you do is you tell the bank directly, every month please deduct this amount of money from my bank account and deposit to these particular accounts. So the bank will do that on your behalf. The standing order are the instructions for the bank to make the regular payments, like maybe the rent expense also. You will give a bank account, okay, the bank account of the person whom you want to deposit things. So the bank will do that on your behalf. Okay, so every month, let's say if you have given a fixed day for 15th of every month, so 15th of every month, whether you inform the bank or not, they will deposit all of these to the respective bank accounts that you have provided. The loan installment, the insurance premiums, or maybe the rent for the factory that you are currently working with, okay, the currently in. So all of these things will be deducted directly from your bank account and will be deposited to the respective bank account. This is what we call payment on standing order. So since you are running a very big business, you might have forget that you have given something called standing order thing. So after you get the statement only, you will understand, okay, this amount of money the bank has reduced from my bank account because of doing these particular standing order payments. So ideally, this is treated as an expense on your point of view because this reduces your bank balance. Okay, it reduces it. Let's say you have 50,000 in your bank account, and because of the standing order payment of 10,000, it tends to be a 40,000, but you have not recorded into your bank account because you're not aware about it. Okay, maybe you forgot to record it. Okay, so that is what the standing order payment is about. Next is going to be the bank charges and the checkbook charges. The bank is working on your behalf, isn't it? They are doing things on your behalf. When you give instructions like the you know, dealing with the standing order payment, so they are doing so many things on your behalf, so they might charge some amount from you, from the business. But the business will not know how much they are charging. It differs based on the service or based on the month. Okay, they might increase, right? So the bank charges are directly the decrease reduced from your bank account, and you don't know. After getting the statement only, you will understand, okay, this amount of money reduced from my bank account because of the bank charges. So bank is charging some amount of money for the service that they do. Okay, that is what you call the bank charges. Checkbook charges is the bank issues a check for the current account holders, right? So they will charge the checkbook amount as well. Are we all good with all of these reasons for getting a different balance here? The differences in the bank account and the bank statement are for all of these reasons. Let's go through the reasons once again. One is going to be the unpresented checks. You have issued a check, but the bank has not presented it for the payment. And the deposited check. The check has been deposited, but the bank has not realized it as an income or the receipts. Next is the direct remittance. Some amount of money has directly come into your account, but you're not aware about it, but the bank has recorded it. So payment on standing order is the payments that has taken place. Okay, payment that has taken place, but you don't know, you might forget as a business, but the bank has recorded is as a decrease in the cash. And finally, the bank charges and the checkbook charges. So these has been debited in the bank statement. Is this bank charge bank accounts balance will be higher or the bank statement one? So the bank statement amount will reduce. Okay, because the bank is charging some amount of money. Let's say that you have around 14,000 in total, the bank charges around 4,000, which means that your bank statement will show as a 10,000 amount, but your account that you're preparing for the business will show up as 14,000 because you have not reduced that 4,000 amount which is charged by the bank. So this results in a decrease in the bank statement, but an increase in your bank account maintained by the business. Are we all good with that? So your bank account shows up as a higher price, a higher amount compared to the bank statement because of the bank charge. So we know like when bank charges some amount, your money will reduce, right? But since you have not recorded into your bank account, there is no effect on your bank account. But your bank, the actual bank has recorded things for you. So the statement shows up a lower balance there. All right. So are we all good with the reasons so far? You have got a question, right? To write the reasons for why you have two different balances. So hope you're done writing the reasons. Can you all type in the reasons if you all can in the chat box? I want the answers from everyone. I'm just getting few answers only from 2 or 3, but not everyone. Yes, the direct remittance. Come on. I want the answers from everyone. It's okay if you're getting the incorrect answer, but I just want you all to try it out. Exactly. Yes, good job, Suhaila and Mubashira. But exactly. So we got the standing orders, the direct remittance, bank charges, unpresented checks, and unrealized checks. So these are some of the reasons why you have two different balances in your bank account and your bank statement. So I have attached you how the bank account looks like. So this is how the bank account looks like. And this is the bank reconciliation statement. Okay. So we have just one more question to complete here, which is why do we prepare a bank reconciliation statement? I hope you're done with all of the questions so far, right? Hope you are doing things in and there. Okay, so we know why difference occur, right? So we know why the difference are taking place in both the bank statement and your bank account. So what we do to identify the difference and to sort things out is just go through these steps. I'm going to explain you and I'll show you as well on how things work and how to compare things. Okay. Exactly. To equalize the balance between the bank account and the bank statement, we have to prepare something called a bank reconciliation statement. Exactly. There we go. Okay. So what we do as a first step is to compare and to identify the differences. We will get both the bank statement and the bank account together and we will start marking down, we will start comparing. So whatever in the debit side, remember, whatever in the debit side of your bank account will be written in the credit column of your bank statement. Opposite way. If you have written something in your debit side, you have to go and check in the credit side of your bank statement. Note it down somewhere. Okay. So when comparing the debit side, the debit column of your bank account, you have to check with the credit column of your bank statement. Just like that, the credit column of your bank account should be compared with the debit column of your bank statement. Okay, so the opposite ways you have to check debit with the credit and the credit with the debit. Are we all good with these two steps? Come on, I want a yes in the chat box if you're all good with that. Okay, so we will be doing a question at the end on this part. Are we all good with comparing them? Whatever in the debit side, you compare with the credit side, and whatever in the credit side, you will compare with the debit side. Okay, so opposite ways you start comparing. Next, what we do is we check with the value. Whether this value is written here, whether this value is written here, like whatever the value that you find in the debit column is written at the credit side of the bank statement, or whatever that is written in the credit column of your bank account is written in the debit column of your bank statement. So you start checking and you mark the ones that you have checked and recorded in both the bank statement and the bank account. Whatever is not marked are the ones with the problem. Okay, so that is how you start comparing and then you check things out. So bank reconciliation statement comes to play in here. So we use the adjusted bank account and the bank reconciliation statement after checking for the accounts with issues. We would use it to sort things out to get a balance in your bank account equal to the one that is in the bank statement. Okay, so we prepare something called a bank reconciliation statement. So a bank reconciliation statement is a document which is prepared to match the balance in a business bank account, start comparing, and you start checking things out on how things work. So the differences might occur because of the timing issues, or maybe because of the errors, or maybe because some accounts are not recorded both the sides. So we have to correctly analyze and do things out in that case. Okay. So this is how the adjusted bank account. To start off, if it's a favorable balance, you would write it in the debit side of your adjusted bank account. Suppose if it's an unfavorable balance, then you would write it in the credit side of your the adjusted bank account. Direct remittance is an income for the business. Now, if you're getting a rent income, or if you are getting an insurance or dividend income, all of these things are income to the business. So when you get an income, where your bank money increases, so you would write it. We know when bank, okay, so when the bank money increases, it's a debit, right? So you would write it in the debit side. So the direct remittance may be the rent income, or maybe the dividend income, or the interest income. This is written in the debit side. Standing order payment, where the money goes out, the rent, the interest payment, or the insurance premium, all of these things are recorded in the credit side. And you would also record the checkbook charges, the bank charges in the credit side, because this is going to reduce the amount that you have in your bank account. And finally, you will balance that off. The higher amount, okay, the higher amount will be written here, and then you subtract with the credit side. If this is a lower balance, you start subtracting the higher amount with the lower balance, and that will be written as a balance carried down and balance brought forward. Hope you all know how to balance it, right? Balancing accounts. All right. And this particular balance that you have over here, okay, the final balance that you get, the one that I have marked in the red color, you will take it to the bank reconciliation statement. You would write it over here. You have, this is how it looks like. Business of who? Bank reconciliation statement for the month of, and you write the month. Adjusted bank balance. So adjusted bank balance is this particular amount that you get when you balance the bank account. So this particular amount will be recorded here as the starting balance. So adjusted bank balance is this particular amount. And you add the unpresented checks. You get the total. You have to add the unpresented check with the adjusted amount. And from the total, you have to realize the unrealized checks. So then you get the final balance, the bank balance as per the bank statement. And this balance should be equal to the balance in your bank statement. That is the case. This amount should be equal to the one in your bank statement, the final balance of your bank statement. So we are, as a business, trying to adjust our bank account according to the amount that is given in the bank statement. We can't say the bank to adjust their statement, right? And they won't make any adjustments as well. So what we do is, we as a business adjust according to the bank statement, our balance according to the bank statement, and then the next month you will carry out smoothly. Again, you check with the bank statement and make adjustments. So that is how it goes on. So this is what we use the bank reconciliation statement. Can you all just let me know whether you have copied down the format so that we can attempt a similar question? Right? So did you all copy down the adjusted bank account format? It can be a T account, or some school they request for you all to write it as a similar format, just like the bank account. There you have the date, description, ledger folio value, date, description, ledger folio value. Okay, so depends. Better if you stick to the other format rather than a T account. T account is much easier. You can stick to the other format, which is a ledger kind of thing for the bank account. Are you all done copying the format? If it's a yes, can you drop a yes in the chat box? Are we done with the format? If it's yes, please type a yes in the chat box. And the next format is the bank reconciliation statement. You can copy this format as well. Are we done copying this format? The bank reconciliation statement. All right, so let's quickly attempt a question on how things work, on how to solve things out. So we're going to use the, activity from the textbook to work with things. So let's start off with an example question. Hope you have the textbook with you, right? So let me explain you on how to compare things and how to attempt a question. I have some questions from the papers as well. So we will be doing that together. So first, let me explain you on how this works. Can you all turn to page 127? Can you all let me know once you're done turning the pages? All right, okay. So what we do is, as a first step, I told you, debit column with a credit column with a debit column. Okay. So the debit column of your bank account. So this is your bank account. The first one over here is a bank account that is prepared by the business. The one at the bottom is the bank statement that is issued by the bank. So how you check for the two different balances is, can you note this last balance? 31,000 over here, right? This is the bank balance, the final balance that we got in our business bank's account. But the bank says that you have only 23,000 in your account. See, it's 23,000 in the bank account, but we have mentioned in the bank account that we have prepared as 31,000, which is more than the bank statement balance. Isn't that correct? So in the bank account prepared by the business, it shows 31,000, but the bank statement shows 23,000. Did you all notice that? Guys, come on. I want the answers from all of y'all. I'm just getting only one answer every time. Come on, others. Did you all understand this part? Two different balances. If it's a yes, please type yes in the chat box. Guys, come on, wake up. Okay, just two more replies. Yes, come on. I want all of y'all to wake up. All right, okay. All right, so did you all understand the two different balances in your account? You all just can write down your own short notes if you all need to, all right? So two different balances, you check the differences from here. Here you got 31,000 and here you got 23,000 differences. So these differences occur for the reasons that we discussed before. Maybe direct remittance, the bank charges, the unrealized checks, the unpresented checks, standing on a payment. These are the reasons for the two different balances. Okay, but we should get our final answer after reconciliation as 23,000. If you get 23,000 as your reconciliation balance, then your answer is correct. That is how you check whether the workings are correct or incorrect. You have to get the balance that you find in the bank statement, the final balance, which is 23,000. After doing all the adjustment, you should get 23,000. You have to adjust your adjusted bank account and the reconciliation in a way that you get 23,000 as your final balance and not 31,000. Are we all good with that part? What some students think is that they should start with 15,000. This 15,000 looks alike, but this is not what we have to compare. We have to compare the final balance. How much is the difference? Can someone tell me how much is the difference between the bank account and the bank statement? What's the difference between the bank account and the bank statement? 8,000, exactly. Okay, so 31,000 subtract 23,000, you get 8,000 as the difference. All right. So are we all good with the identifying where the mistake is? I mean the wrong. Okay, with two different balances. We'll just check the last point over there. And now it's time for us to compare the debit with the debit and the credit with the credit. All right. So I'm just going to draw a rectangle around so it's easy for y'all to, understand things. So this is called the receipt side. The debit side is called the receipt side. And the credit side is called the payment side, right? So the debit side with the credit side of your bank statement should be compared. The debit side with the credit side of your bank statement. Okay. So hope you all can see that I have drawn a rectangle close to it. And then you can start marking ticks. You compare, you mark the things that looks the same. Okay. So debit side with the credit side. So don't consider the balance brought forward. That's already written over here. It's the balance, the starting balance. So some students, what they say is, okay, 50,000 is here, but not here. It is, yeah, but it's written as a balance. The balance don't want to compare. Compare with the cash deposit. Here there is 8,000 and here also you find 8,000. So that's done. No problem with that. Here you find 12,000. Here also you find 12,000. No problem with that. Here you find 5,000 and here you find 5,000. That is correct. And you find 7,000 here and you find 7,000 here. Now you got certain things that is not marked, right? That is not ticked and that is not identified, which is check deposit 58. Check number 58, 14,000 is not seen in the credit side, right? Did you all identify that, guys? It's not written in the credit side. The 14,000 amount is not even written in the credit side. So that is a error. Okay, I mean maybe it is called the I'll explain you what it is. So that is one of the reason for the problem, the difference. Did you understand how I identified that 14,000? First you have to compare the debit with the credit side, marking it, and then you check for what is not marked. And here it is 11,000, we have not marked it. And that belongs to the direct remittance from the debtors. Are we all with this part, guys? Okay, that's great. So what do we do next? Are we done? What do we do next? Come on, guys. What do we do next? Now, okay, no, we have to compare the credit column with the debit column. Exactly, there we go. Awesome effort. Okay, so we start comparing the other way around. Okay, the credit column of your bank account with the debit column of your bank statement. There we go. So now let's start comparing just like how we did things. 10,000 over here and 10,000 over here. 4,000 over here and 4,000 over here. The problem is that we have not recorded the 16,000. We don't find 16,000, which is written in the credit side of your bank account in the bank statement, right? So that is a problem. And next is the standing order. You have paid the bank loan installment, which is 18,000 is not recorded, and the bank charges of 3,000 is also not recorded. So forget about this 31,000, which is a balance carried down. Okay, so this is different. You don't want to record. It's not a transaction. It's just the final balance, which is used to balance the account off. All right. So are we all good with identifying the differences, guys? Any questions, anyone? So we were able to identify the problem, right? So the check deposit, which is check number 58, 14,000 is not recorded. And the creditor, 16,000 is not recorded. And we have got the 11,000, which is the direct remittance is not recorded. Standing order is not recorded. Bank charges are not recorded. So these 5 things are the reasons for the differences in your bank account and the bank statement prepared by the bank. Are we all good with this? Identifying the problem. Guys, I want yes from everyone here. Come on. All right. Good job. Okay. So that's about it. So what do we do next then? What do we do next after identifying things? Come on, guys. Exactly. We start creating the adjusted bank account and the bank reconciliation statement. Okay. All right. So if you all want, you all can start working out this question with me. Okay. So where you start creating up things. All right. So let's quickly start working on these questions. I'm going to take you to another slide now. Here we go. Mhm. So I'm going to use a T account format. If you all wish, you can use a T account format. Y'all can use the normal format of writing out things. So I have just opened up the Excel. I got the adjusted bank account and the bank reconciliation statement. Hope you can see this clearly, right? Guys. Yes, exactly. Okay, I'll explain that part. So quickly what you do is, now when you get such question, you have to first draw and work down the requirements. Your requirements will be to create create an adjusted bank account and the bank reconciliation statement. So what we do is, when your requirement in the question is about creating an adjusted bank account and the bank reconciliation statement, quickly draw those two. Okay, don't first draw the adjusted bank account and complete that and then draw the bank reconciliation. That's going to confuse you more and it consumes lots of time there, because you have to go through all the transaction all over again. So better if you draw both of these together. Okay, draw the requirements together, whether it's a profit or loss statement or anything. You have to draw the tables according to the requirement. Okay, so I have drawn the adjusted bank account and the bank reconciliation statement. So according to the business, you can start naming it. So I have not mentioned the name of the business. Let's just write it as an Adhika's business. All right. So I'm just going to write it as okay. So I have just given a date over there. Okay, are we all good with the adjusted bank account and the bank reconciliation statement? Are we done drawing this, guys? Are we done with this? Are we all good with the format? Okay, so now it's time for us to record things out. Okay, one moment. We're going to check with things what we have to record. All right, so let me explain you what things and where you should record it. So whatever in your bank account, okay, do remember you can keep a note somewhere. Whatever in your bank account which is not recorded in your bank statement will be an unrealized check or unpresented checks. Okay, it will be unrealized or unpresented, which you have to write it in the bank reconciliation statement. So the incorrect one, see the 14,000, this 16,000 will be written in the bank reconciliation statement and not in the adjusted bank account. Okay, remember that. Keep a note that bank account, the mistakes that you find, the one whatever that you have marked in your bank account will be written in your bank reconciliation statement. So it can be unpresented or unrealized check. So let me explain you how to identify the unrealized check and unpresented checks. We know that unpresented checks are the checks that are not present to the bank. You have issued it but not present to the bank. Okay, so these ones are recorded in your debit side. I mean, over here, okay, the credit side. Because when you issue a check, what happens? Your bank account will reduce, right? Your bank account will reduce. It turns to be a bank account credit, right? So this 16,000 over here is unpresented check. Let me show you an easy way of identifying that. Unpresented. So this column, the credit side is called the payment side, right? Isn't that correct? You just call it now. Some people they call it as a payment side because it is a credit, it reduces your balance. While the debit side is called as a receipts. The income that you get, whatever the money that comes into the business are recorded in the debit side, right? You call it as a receipts. Okay, so we got the receipts and we got the payment. So payment, money goes out. Receipts, money comes in. All right. So unpresented check. See the starting letter of this. Letter P, right? And for the payment, you got the letter P, which means that this 16,000 is an unpresented checks. Okay, so some students, they get confused whether the debit side is unpresented checks or the credit side is unpresented check. Remember that the credit side is going to be the unpresented checks of 16,000, while unrealized see the first letter. Okay, starts with the letter R, and here you got the letter R for the realized thing, right? So this 14,000 is the unrealized check. So unrealized checks are like you have deposited the check into a bank account where it increases your bank balance. Okay, it increases your bank balance. You have recorded in your account as a debit, but the bank has not. Okay, so this is what you call the unrealized checks. Are we all good with identifying the unrealized checks and unpresented checks? Okay, so we were able to identify an easy way of identifying it, yeah? The letter R and the letter P. All good, guys? So let's quickly record this as unrealized and unpresented. So make sure that you write the check number there. You can write it as check number 114, 16,000, which is unpresented checks. And then we got the check number 58 as unrealized. Okay, let's quickly start recording that. How much is unpresented checks? 16,000, yes. And you can record the check number inside the brackets, which is check number 114. And next you got unrealized checks. Okay, so which is going to be around 14,000, right? Exactly. Okay, thank you so much. Okay, so we are done recording the unrealized and unpresented checks. Guys, are we all good with the recording these two? All right. Okay, so now we are done recording the mistakes that we found in the bank account. Now let's move on to the bank statement. So in here, whatever that is written in the credit side, we already know that we should write in the debit side. And whatever that is written in the debit side, you should write in the credit side. So let's start off with 11,000, which is direct remittance. Do we write in the debit or the credit side? And do remember that whatever the mistakes, I mean, the issues that you found in the bank statement, you would record it in the adjusted bank account. You can keep a note of that, okay? So the marked ones, you can say the marked ones, or you now these ones are unmarked, right? So the unmarked ones in the bank statement are recorded or are adjusted in the adjusted bank account. Are adjusted in the adjusted bank account. And which balance are we starting with? Come on, anyone wish to give a try? Are we starting to work out with 15,000 as a balance brought down, or 31,000? Which amount are we going to start with? Okay, we always start with the final balance that you got in your bank account, which is 31,000. Remember, not 15,000 or not 23,000. We're going to start with 31,000. Okay, so 31,000, which is the balance brought forward amount in your bank account. Because we are not going to correct the mistake of the bank, but we are going to correct the mistake of the business. All right, means like the differences in the account. So 31,000 is the balance that we're going to start with. So balance brought forward. This is a favorable balances you can find the debit side of your bank account. Okay, 31,000. Are we all good with this, guys? Starting with 31,000. And now we have to look into the ones that is written in the debit side into your credit side of your adjusted bank account, and whatever written in the credit side is going to be written in the debit side of your adjusted bank account. So starting off with the 11,000 direct remittance from the debtors, where do we write it in our adjusted bank account? Debit or the credit side? Come on, guys. 11,000 is written direct remittance, exactly. We write it in the debit side. Okay, direct remittance of 11,000. Okay, so we are done with recording that, and now let's move on to the next one, the debit ones. You find the standing order and bank charges. Where do you think that you record these? Standing order and the bank charges. Come on, guys, debit or credit in your adjusted bank account. Standing order, bank charges. Okay, there we go. So we would record this 18,000 and 3,000. Standing order is in the debit side of your bank statement, which means that you will record in the credit side. Okay, so you will place this in the credit side. So standing order payment 18,000. Okay, so are we all good with these recordings? So we are done with recording. Okay. Okay, so guys, I want a yes if you're all good with these, so that we can move to the next part. Come on. All right. So now it's time for us to balance things off. Okay, we're going to balance it. Balancing the account. All right. So you would get around, how much do we write it here? How much do we write, guys? Okay, so guys, what do we do? What do we write as a total amount? So at the debit side, you get 41,000, and in the credit side, you get around 21,000. So 21,000 is less, right? So what you do is you write 42,000 here. So 42,000 will be written. And the balance carried down will be written in your credit side. The reason is you have the less balance, right? In your credit side. So you would write balance carried down. So balance carried down. How much is the balance carried down, guys? How much is the balance carried down amount? Come on. So how we find the balance carried down amount is, we were able to identify the total of this is 42,000, right? So you find the total of this side, which is 21,000. So 42,000 subtract 21,000 helps you to get the answer of 21,000. So that will be written as the balance carried down. The same answer, you would write it in the balance brought forward. So this is going to be the next balance that you're going to start with. Are we done or do we have 4 steps to work with? Come on, guys. Okay, yes, we do have more steps to work with. So this 21,000 that we have got over here as a balance brought forward, we would write it under the balance as per the adjusted bank account. Okay, the balance as per the adjusted bank account. So you would write this amount, which is 21,000. And you would also write the 16,000 over here, where you're going to find the total of it. How much do you get when you add them together? 16,000 at 21,000. 16,000 at 21,000 equals to, yes, it is 37,000. So from this 37,000, it says less unrealized checks, right? So you write it within the bracket. Why are we writing within the bracket? The reason is so that we will understand, okay, we have to subtract it. Okay, so that is why we are writing it within the bracket. So you do the subtraction to find the balance as per the adjusted bank account, where you do 37,000 subtract 14,000. Okay, how much do you get when you do the subtraction? So we get 23,000, right? Are we all good with that, guys? So now let's check with the balance. So this 23,000 should be same as the one over here. See, the final balance of your bank statement is also 23,000, isn't it? The balance in your bank statement is also 23,000, and the balance that you got after adjusting is also 23,000, which means that your answer is correct. So this is how you check whether your answer is correct or incorrect. Are we all good with that, guys? Any questions here? So you get the same answer there, just like the bank statement, which means your accounts are correct. Guys, any questions, anyone? Hello?
Yeah, miss.
Do you have any questions?
No.
All right. Okay, so this is about the questions that I told you that I would share it. Okay, let's see how quickly you're going to work out this question. Come on, start working on it. Okay, I want you all to quickly work out this question and tell me your final balance that you get in your adjusted bank account and the reconciliation statement. And I'm just going to give you around 6 minutes time to work out these two questions. All right. Okay, so we are left with only 2 minutes. Come on, guys, try your best to work out this question. Okay, so it's time for us to check the answers. Anyone who have completed the question? Anyone who has completed the question? Shall I give you 2 more minutes to work out the question? I need the final balance of the reconciliation statement. Okay, guys, let's check the answers then. Can you all drop your answers into the chat box, please? Okay. All right, so here we go with the answers. The start off with 16,000, which is a favorable balance in your debit side. Standing on a payment is written in your credit side because it is a credit transaction, because when you do the payment, your bank account, the money in your bank will reduce. So you start balancing this off and you get 11,000. How you get 11,000 is 16,000 subtract 5,000. Helps you to get the answer of 11,000. And this 11,000 will be written as a balance as per the adjusted bank account over here. And with this, you add the unpresented checks of 3,000. In total, you get 4,000. So 4,000 subtract 2,000, which is the unrealized checks. And you get the final answer as 12,000. So 12,000 is going to be the balance as per the bank statement. Are we all good with this, guys? Are we all good with this? Okay, so that's about this chapter then. That brings us to the end of this session. So hope you found the lesson useful and productive. Okay then, thank you for joining. Bye, have a wonderful day.